Today, why is the household sector turning so weak? Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to discuss a recent speech from the RBA, which looks at the strange relationship between employment, which continues to boom, and poor household sentiment and spending. There's something going on here, and we wonder whether the RBA is really understanding the dynamics that we also see in our household surveys. And just a reminder, if you get value from our work and you want to help us to continue to make great content, you can do so by joining our Patreon program, here is the link, or making a one-off donation via PayPal, and again, here is the link, and both those links are in the comments below. Your support is significant and important to us to enable us to continue to do what we do. So the RBA's Lucy Ellis, who is Assistant Governor Economics, spoke yesterday and gave a speech entitled "What's Up and Down with Households?" And essentially it was a study of the relationship between the labour markets, which are strong, she said, and the broader economy, and particularly the disconnect with the household sector, where consumption appears to be easing. And one of the factors she highlighted was that household spending is slowing, especially on cars and other household goods. Now, we regard this as an important indicator because income, of course, is under pressure in real terms, and costs are rising, and home prices are falling, and confidence levels are easing. So we think households are hunkering down. And indeed, as the RBA said, at some point, households may conclude that this status is not temporary and that low-income growth will persist. And at that point, they would be likely to adjust their spending plans, and consumption growth would then slow. So let's have a look in more detail at what she said. So let's start with the labour market, which she said has been strong. The unemployment rate declined by 0.5% through 2018 and has reached 5%. And that 5% was achieved slightly ahead of what the RBA forecast. And she also made the point that youth unemployment had declined a little, and other measures of underemployment are also a little easier too. She goes on to show that the employment growth was not uniform across all the industries. We saw a significant rise in household services and in health care and social assistance. And one of the factors we've been talking about previously is that the most strong rises in employment are in areas relating specifically to supporting, for example, older Australians and other household-related matters. So the point about that particular segment of the market is it does not create growth or outcomes, economically speaking. She also makes the point that the private sector growth in income has moved up a little, and the public sector is doing pretty well. But of course, it's worth reflecting on the fact that this is in essentially current day terms, but not adjusted for inflation or CPI. So in real terms, wages growth is still close to zero. But whilst that may sound quite positive, the fact is that the growth in household income has been slow, and growth in consumption has weakened recently. Now, what's interesting about the analysis that she then showed was that some types of spending have slowed more than others. And indeed, spending on cars and household goods has been particularly affected, while spending on less discretionary items such as food has been less affected. Now, she goes on to dismiss the so-called wealth effects from declining housing prices, because essentially she argues that it will depend on how far prices had moved up previously and whether in fact households still feel wealthy. She referred to some recent work at the Reserve Bank which said that people don't suddenly wake up one morning and realise their home is worth more and decide to go out shopping. Rather, if their home is worth more, they can borrow more against it, which matters for some people's decisions to buy a car. And because rising housing prices usually occur in the context of high rates of transactions in the market, spending on home furnishings tends to rise and fall with housing prices. So when housing prices decline, turnover also declines. And this means that there are fewer people moving house and realising their old couch doesn't fit, or they need new furnishings in the extra bedroom. Or in other words, as housing transactions slow, so will discretionary spending slow. Now, one of the other aspects that she considered was the fact that household disposable income growth is essentially not just labour income, which is actually not that strong. There are other sources of income which have also now been weak, and this has been continuing more recently. Now, within the non-labour income, the main components are social assistance, rental income, other investment income, and the earnings of unincorporated businesses. It turns out that a confluence of factors have resulted in growth in most of these categories of income being weak recently. In some cases, this is a trend change that is likely to persist, whilst others may be driven by shorter-term factors which could reverse in coming years. So looking at non-labour related income, we see some quite interesting dynamics in play. For example, social assistance payments have been relatively flat for a number of years. As the labour market has strengthened and unemployment has come down, it's not surprising that some forms of social assistance have not been growing. Firstly, the rate of growth of age pensions payments has slowed, though it is still positive. Now, there are a number of probable drivers of this, including the increase in the eligibility age, as well as more people above the higher eligibility age remaining in the workforce rather than drawing a pension. And our surveys suggest that people are working longer into older age, partly because they choose to, but partly also because they still need to, because they've still got that pesky mortgage to pay off. And it's also possible, she said, that as time goes on and the people who are retiring have had longer to accumulate superannuation balances, more people are receiving a part-time pension to go with an income stream from their superannuation. And she also notes that in recent years, growth in social welfare spending by the government has come from new programs like the NDS that are counted as government consumption, not household income, in the national accounts. So while both disability payments and other payments to families with children have been broadly constant in dollar terms for several years, government consumption has been growing strongly over the same period. In fact, if we adjust for this, the growth in the social assistance component of household income would look much closer to its average over the past, rather than being below average. Now, she went on to look at rental incomes, which have also been weak. And she said this is not surprising, considering that rents have been rising only slowly in most cities and falling for a few years in Perth, and by the way, now in Sydney. But rental income is only earned by 15% of taxpayers, and lower cash rental income for landlords is also lower rent paid by renters, leaving them with more money to pay for other things. So the weaknesses in rental income is unlikely, she said, to be a large driver of any slowdown in consumer spending. And income from other kinds of investments have also been weaker, but have recovered in the last few months. And one other fact that's worth considering, she says, is to do with tax and other payments, because they are dragging on disposable income. Now, despite the relatively weak picture for household income growth, the tax revenue collected from households has grown solidly in recent years. It's normal for growth in tax revenues to outpace income growth a bit. That's how a progressive tax system works. And in fact, a useful rule of thumb is that in the absence of adjustments of tax brackets to allow for bracket creep, for every 1 percentage point of growth in household income, taxes paid by households will on average increase by about 1.4 percentage points. And that's an on average figure. The ratio, of course, can vary quite a bit. But interestingly, in the past year, taxes paid by households increased by around 8%, more than double the rate of growth in gross household income of 3.5%. So the ratio is more like a bit over 2 to 1 at the moment, rather than the 1.4 to 1. That's at the high end of the ratios, and that's shown in the graph. Whilst it's not unprecedented, this effect has accumulated over time as the share of income that is paid in tax has been rising. And she said it's noteworthy that for all of the past 6 years, growth in tax paid has exceeded income growth by an above average margin, at a time when income growth itself has been slow. There are a number of elements which may explain what's going on. Aside from the usual bracket creep, some deductions and offsets have declined, boosting the net tax take. Interest rates on investment property loans are now higher than for owner-occupiers, but overall the interest rate structure on mortgages is lower than it was a few years ago. So landlords will have lower tax deductions for interest payments on loans on investment properties. And at the same time, the significant run-up in housing prices in some cities over the past decade will have increased the capital gains tax liability paid by investors selling a property, and turnover in the housing market has declined. But, she said, as best we can tell, the price effect has dominated the effect of declining volumes, and total capital gains tax paid has increased. And then, of course, there's compliance efforts and technological progress in tax collections, which have boosted revenue collection from a given income. The tax office, she said, reports that its efforts to raise compliance around work-related deductions has boosted revenue noticeably. Now, what I find interesting about this particular discussion is that there seem to be a number of elements thrown up by the Reserve Bank to try and explain the pressure on incomes and the fact that households' discretionary spending is tightening. And some of the things that she's highlighted are probably correct. But it seems to me that she's missing a couple of really obvious points. The first one is we know that more and more households are just finding that the everyday costs of living are continuing to get away from them. And that comes through in our mortgage stress data, with more than 1 million households now struggling to meet those repayments and to cover all the other costs of day-to-day expenditure. The second point to make is that the income growth is actually not average across all households. In fact, more affluent households have tended to have larger income rises, whereas those on lower incomes have tended to have lower levels of income increase over recent times, other than perhaps the basic wage, which has helped a little, but many of those people don't necessarily have some of the same commitments as more affluent households. So it seems to me that the Reserve Bank has not actually adequately explained the contention between unemployment at a very low level and the pressure on household finances and on disposable income. I think perhaps that one of the things we need to come back to is the definition of employed or unemployed. And of course, the ABS uses a particular definition which is pretty tight. Anybody who works for an hour or more a week is classed as employed. And only those who are actively seeking a job but doesn't have a job are classed as unemployed. And on some other measures, for example, the Roy Morgan measure, the unemployment rate is considerably higher. So standing back, it seems to me that the really obvious point to make here is that it is the long, slow grind of household finances which is to blame for what's going on at the moment. Households are hunkering down, they're spending less, they have less ability to spend. And unless there is a significant change in the weather with regard to future income growth, which frankly I think is unlikely, I don't think this is going to change anytime soon. And by the way, if the Reserve Bank did decide to cut interest rates a little, that would hardly have any impact on most households. Final point I'll make is that we also know that some more affluent households, particularly those with interest-only loans and multiple mortgages and multiple properties are ones which are also now struggling consistently. And so even more affluent households are also beginning to hunker down pretty hard. And so it's my expectation that we will see the contribution to the overall GDP from the household consumption sector continuing to fall over the next few months. And that, it seems to me, is going to create a significant problem for the Reserve Bank, bearing in mind that about half of GDP comes from household consumption. So expect lower levels of GDP reported ahead. I'm Martin North from Digital Finance Analytics. If you found this post useful or informative, please like it, share it, add a comment or a question. I read them all. And if you haven't yet subscribed, do ring that bell to subscribe to receive alerts for future posts. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.